Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of what to do during a market crash, a guide for investors. Algorithmic trading and high-frequency trading. Algorithmic trading, often referred to as algo trading, uses computer programs to trade stocks at lightning speed. It analyzes vast amounts of data and executes trades in the blink of an eye. This quick action sounds great for capitalizing on small price changes, but what happens during a market downturn? Here's the rub. Algorithms can escalate a crash. When markets show signs of trouble, algorithms can start selling all at once, creating a domino effect. It's like a snowball rolling down a hill, gathering speed and size. The more it rolls, the more it crashes through everything in its path. Speed over substance. High-frequency trading, a form of algo trading, prioritizes speed over everything else. This can lead to massive selling pressure and volatile swings. Volume amplifies downturns. With hundreds or thousands of trades happening in seconds, a slight dip can look like a nosedive, turning cautious market movements into panic. The speed and volume provided by these traders can overwhelm human traders, making it tough for traditional methods to stabilize the market. Information dissemination via social media. We live in a world where news travels quicker than ever, often breaking on Twitter before media outlets can catch up. Social media has become a major player in how we receive information, markets are no exception. But rapid information isn't always helpful. The speed of social media can amplify fear and uncertainty, affecting market sentiments almost immediately. Imagine a viral tweet predicting a major downturn. Even if it's baseless, it can lead to real-world consequences as people react. Misinformation mayhem. Fake news and rumors on social media can mislead investors, causing panic selling. Instant reactions. Unlike traditional news, there are no fact-checkers or editors slowing the spread. This can lead to hasty decisions by traders reading incomplete or inaccurate reports. Social media acts like a megaphone, where a whisper can turn into a shout heard around the globe. It's vital for investors to sift through the noise and focus on verified information. In a way, navigating market crashes in the internet age is like steering a ship through a storm while everyone on board is shouting different directions. Understanding these roles technology plays in market crashes is crucial for investors and analysts. It can help them keep their cool, even when digital voices loudly suggest jumping ship. Surviving a market crash. Surviving a market crash can feel like braving a storm at sea. The waves are high and the wind is fierce, but with the right strategies, you can navigate through. Let's explore how you can stay afloat when the financial currents get rough. Diversification and asset allocation. Imagine your investments as a basket. If all your eggs are in one basket and it drops, you could break them all at once. That's why diversification is key. By spreading your investments across various assets, you're less likely to experience total loss. Here's how it works. Stocks. Don't put all your money in one company. Invest in a mix of different industries. Bonds. These can be more stable than stocks and provide a steady return. Real estate. Property can be a solid investment, offering rental income and potential appreciation. Commodities. Gold, silver, and other commodities can act as safety nets during downturns. This mix is known as asset allocation. It's like a recipe. Too much of one ingredient and the dish can fall flat. Balance is essential. Is your portfolio like a well-balanced meal? Long-term investment strategies. Keeping your eye on the horizon, not the daily waves, is crucial in investing. When markets crash, it's easy to panic and sell off investments. But think of your investments like planting a tree. Trees don't grow overnight. They need time, sunlight, and patience. Similarly, your investments need time to mature. Long-term strategies involve stay the course. Panic selling often leads to losses. Remember why you invested in the first place. Reevaluate, don't react. Take a deep breath and evaluate your portfolio. Are the fundamentals of your investments still strong? Buy opportunities. Market crashes can lower stock prices. If you have the means, think of this as a sale you can take advantage of for long-term growth. By sticking to these strategies, you can turn market downturns into learning opportunities rather than financial setbacks. Ask yourself, are you investing for the short sprint or the marathon? Lessons learned from past crashes. Understanding past market crashes is like peering into a historical mirror. These events tell us what went wrong and how to avoid similar pitfalls in the future. By learning from these lessons, investors can prepare for uncertain times and navigate the stock market with more confidence. Regulatory changes post-crash. When markets crash, they create ripple effects that can impact financial systems for years. One immediate result of these crashes is the push for regulatory changes. Think of these changes like new traffic rules after a series of car accidents. They're meant to keep everyone safer on the financial highway. For example, following the 1929 crash that led to the Great Depression, we saw the creation of the SEC, Securities and Exchange Commission, to enforce federal laws. More recently, the 2008 financial crisis brought about the Dodd-Frank Act, a sweeping set of reforms aimed at reducing risks in the banking sector. These regulations sought to enhance transparency. Companies were required to disclose more information, helping investors make informed decisions. Limit risky behaviors. By imposing restrictions on certain trading practices, regulators aim to curb excessive risk-taking. Protect consumers. New rules ensured that financial institutions acted in the best interest of their clients. These steps, while not foolproof, aim to prevent a repeat of disastrous events. They serve as a constant reminder of the costs associated with unregulated markets. Investor behavior and market psychology. Market crashes also leave a lasting impression on investor behavior. Like a hot stove that burns a curious hand, these events teach investors to be cautious. But sometimes, they cause overreactions, leading to volatility that feels like a roller coaster ride. Here are a few ways crashes affect investor psychology. Fear and panic selling. When markets tumble, fear can spread faster than a wildfire. Investors often rush to sell their stocks, fearing further losses, which can deepen the downturn. Herd mentality. Investors might follow the crowd during turbulent times, buying or selling because others do. This can drive wild price swings. Cautious optimism. After a crash, some investors become more careful, learning to balance risk with potential reward. They diversify portfolios and educate themselves about market trends. Understanding these behaviors helps us recognize patterns and make smarter decisions. By staying calm and informed, investors can avoid the pitfalls of panic and make choices that align with their financial goals. As we reflect on these lessons, it's clear that the past has shaped the present market landscape. While we can't predict the future, we can learn from history to better prepare for what's ahead. Future outlook. Can we predict market crashes? Trying to foresee a market crash is like attempting to predict the weather. While it can be tricky, there are some tools and techniques that might give us hints about what's coming. Let's explore whether we can truly predict these market downturns and the methods that experts use to try to stay ahead of the curve. Technical analysis and market signals. Technical analysts scrutinize past market data, primarily price and volume, to identify patterns that might signal an impending crash. This approach is like reading the stock market's pulse to check for irregular heartbeats indicating trouble. Here are some commonly used techniques. Moving averages. By analyzing the average price of a stock or an index over a set time period, analysts can spot trends. A drop below a significant moving average might indicate a bearish trend. Relative Strength Index, RSI. This measures the speed and change of price movements, helping investors determine if a stock is overbought or oversold. An extremely high RSI can be a red flag for a potential downturn. Market breadth indicators. These assess the overall market strength by looking at the number of stocks advancing versus those declining. A market dominated by declining stocks could suggest an upcoming decline. These tools aren't foolproof, but they offer clues that can help investors make more informed decisions. Economic forecasting models. Economists use various data points to create models that forecast potential economic downturns. These models resemble a roadmap that helps anticipate roadblocks ahead. Key elements in economic forecasting include GDP trends. A sluggish or contracting gross domestic product can indicate an economy heading toward a crash. Watching this metric is like keeping an eye on your car's fuel gauge. Unemployment rates. Rising unemployment often hints at economic trouble, signaling reduced consumer spending and business investments. Interest rates. Central bank policies on interest rates can either encourage spending or saving. A sudden hike may slow down the economy, potentially leading to a downturn. These models combine historical data with current economic indicators to paint a picture of where the market might be headed. While predicting market crashes with absolute certainty is impossible, understanding and using these techniques can give investors a better shot at navigating the financial seas. Ultimately, keeping a keen eye on both technical signals and economic models helps in staying alert and prepared for whatever storms may come. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.